Hello. In this episode of InCredible Insights, I'm going to talk about two contrarian themes in the portfolio. First is our underweight call on financials as a sector. As most of you are aware that financials can be broadly divided into lending and non-lending institutions, and the lending institutions can be further divided into NBFC and banks. On the non-lending side, predominantly we have exposure towards insurance companies, both life and general. We have preferred to go overweight on insurance companies vis-a-vis the lending institutions, and the reasons are the following. 6 months back, we took this very bold call of, essentially going underweight on the sector, and that call was predicated on the belief that you have record high net interest margins for lending institutions, which is banks and predominantly NBFCs. You also had this environment wherein the credit growth was the third highest on record. And this reminds me of the era wherein from 2004 to 2008, the credit growth was very, very strong in the system. And this also coincided with the best asset quality that I have seen as an investor over the last 20 odd years of investing career. Now, our very simple belief was this is a business of, in the business of lending, you cannot have a scenario wherein, something has to, give up here, essentially. And what we essentially saw in the first phase was that net interest margins came under pressure, essentially because of the cost of deposits going up in the system, and that was very, very broad-based, and it has been coming to the fore. Now we are in a cycle wherein the regulator is forcing certain NBFCs to take stern steps in terms of focusing on the processes that they have been following. And we believe that, some of the actions, we are at a very early stage of the cycle which is playing out in NBFCs. So we have had this tendency of avoiding NBFCs, and within NBFCs we would prefer to be focused on secured lenders rather than focusing on unsecured lenders. On the banking side, our focus is again on banks which will benefit, and there is a bank that we own which is going to benefit immensely out of this gold loan saga that we are witnessing at this point in time. And obviously, predominantly this bank has got more than 50% of its loan book towards gold loans. So what we believe is that, as the regulatory action plays out, the banks which are focused on gold loan lending would benefit. The second theme that I am going to talk about is again a contrarian play, wherein we are increasing our weight on consumption stories, particularly focused on low unit consumption in this country. Now, we are at a very, very interesting juncture, because what we have seen over the last 4 years post-COVID is that rural has really not recovered. So there are multiple categories wherein the sales post-COVID has not recovered to the pre-COVID level. And this is where we are focusing on. If we look at the construct here, the CPI inflation, the rural CPI inflation is broadly down from 7.6% to 5.3%. The rural unemployment rates are down from 8% at its peak to 5.8%. We are already witnessing some recovery in demand in two-wheeler sales, and on a YOY basis, two-wheeler sales are already up 22% in the recently reported numbers. Now, one element of strategy here is to focus on both two-wheeler stocks as well as two-wheeler auto ancillary stocks, and this is something that we essentially like as a part of our portfolio positioning play. Tractor recovery has been tepid, but our belief is that, again drawing a parallel between 2004 to 8, as the industrial activity picks up, our belief is that, the usage of tractor could be driven by non-agri usage. So tractor recovery should pick up going forward. Now, if you look at a very, very important element of rural recovery theme, it is going to be closely linked to how the minimum support price of crops is. And generally going into election year, as it is widely believed that minimum support price from the government perspective is going to be, fairly constructive. And this is what we are seeing. At this point in time, you have 50% higher minimum support price from the cost of production. And this is what the benchmark is. So our belief is that, as we get into the election year, rural should recover. As a logical consequence of this, we are positive on the prospects of smaller appliances companies, companies which are focused on durables, particularly low unit consumption, and fans being an example here. So what we have added is that, we have added a supplier of brushless DC motors in the portfolio. We have also added a company wherein it is focusing on small consumer durables. So these are the two themes that I wanted to talk about. Both are plays wherein one, we were underweight on the sector, that is 6 months back, how it helped us in terms of, avoiding a sharp drawdown for our investors. And the second one is a high conviction play. What we believe is that, from a 2 to 3 year perspective, the consumption stocks have a decent potential here in terms of PE multiple contraction, which is already behind us. And as consumption improves, obviously, this should flow into stock prices as well. Thanks a lot.